Hey, it's Luke from Alberta On Fire Investor Team. Today we're going to talk about what is the best investment property and product to purchase. We're looking at single family properties versus multifamily. Before we get started, make sure you click the link below to get our investing guide to help you get started with investment real estate. Now, I've said this before, but it really does come down to your investment goals and each different individual. Whether or not to start with single family rentals or multifamily will depend on your skill set, your experience, and your team of professionals. So let's dive in. Let's get started with single family rentals. That could be just one single family house rented to one tenant, ideally for a longer period of time. Typically we have less turnover for this style, but we can also have break-even cash flow, sometimes negative cash flow. The next step up would be a two-door rental, single family property with a secondary legal suite will help you just insulate from a carrying cost perspective and from a risk perspective. If one unit does become vacant, you still have the rental income from the other unit. The single family option rented to one tenant is the easiest to manage, but if you do have vacancy, now you're looking at zero rental income, but still all of the carrying costs. One benefit to single family rentals is they are typically at a lower entry point, as the homes are cheaper in comparison to multifamily options, and they're a lot of times easier to sell because you are selling to maybe an investor, but you can also sell to a homeowner. Now, financing on a single family residential home is heavily based on your annual income and your debt ratios versus a multifamily property that's either zone commercial or can qualify for commercial financing, which is 5 units or more, is more focused on the product itself instead of the individual's annual income. So in this scenario, this does benefit the person that's maybe retired or has different sources of income or self-employed, but has the cash reserve and the product type. It can be easier to scale up with commercial lending because we're looking at more the product itself and the performance and cash flow and cap rates instead of the individual and their qualification. Now let's talk about multifamily. So multifamily can be anything from 2 to 4 doors on the smaller multifamily side, and anything 5 units and up is typically zoned as commercial or maybe residential, but may be able to qualify for commercial financing, which is very versatile in today's investment world. If you do not own real estate yet and you're a first-time home buyer, you can purchase up to a 4-plex as a primary residence, live in 1 unit and rent out the other 3 units to live basically cost-free, and if not, put a little bit of cash in your jeans to really just accelerate your investing career. This will make it a lot easier to scale up. It's also a lower entry point. Because you are moving into it, you do not have to put the full 20% down payment in. You actually can put as little as 5% depending on the price point, and typically somewhere between 5 and 10%, which is a great way to boost your ROI and also to leverage your existing capital to its fullest. If you're not going to move into your rental property and you're looking for a lower entry point but still with more than one income, then a single family property with a secondary suite is a great starting point, as it's just that next step up in purchase price point from the single family option, but you're a little bit more insulated because now you have 2 rental incomes instead of just 1. This does lower risk, but also boost cash flow, which is great obviously from a monthly standpoint to building your wealth, but also when we look at qualifying at the bank level and helping with your debt servicing ratios. The next step up from a single family home with a secondary suite would be a triplex or 4-plex. Now these are still zoned as residential because there are 4 units and under. This is another great way to get into smaller multifamily create that insulation with multiple rental incomes. These can become a little bit more difficult to offload because they're not as desirable as that hybrid type of primary residence, although there are some eager investors out there. So this would be more catered to an investor sale down the road as our exit strategy. But typically we do see some healthy cash flow because of the additional rental incomes that we can acquire. Now let's talk about commercial buildings. Typically these are 5 units and up. Traditionally, what investors think of is a 12 unit, a 16 unit, a 40 unit apartment building. That's maybe a little bit older, central location typically. These are interesting, but we do find they can be a bit harder to offload down the road, as you only have one end user, which is an investor qualified buyer. Now, the hybrid of these two models would be zoned residential with secondary suites, getting us over those 5 units so we can look at commercial lending, but also we can look at residential financing as well. So we can pick the one that fits our needs at that time. A lot of people will max out their residential financing first and then pivot over to commercial financing so they can continue to scale up and grow their portfolio from there. Another thing to consider with commercial property is traditional commercial financing typically will require a minimum of 25% down and usually even upwards to 35, even 40%, depending on the corporation or entity that's qualifying for that lending product. Now, commercial buildings can be more difficult to find as they're not always listed on the public markets. Most of the time, commercial buildings are listed privately with investment-focused realtors, and they're sold from one investor to another investor privately off-market. So this is good and bad. This means that they are hard to find, they are rare, but this also can allow for opportunity to bring in joint venture partners that don't have access to these type of properties. And now you have the value of bringing a commercial building under contract to a potential JV partner and getting that deal done for you and for your joint venture partner. So in summary, as a new investor, single family options would be the easiest entry point from a management perspective and a cash in perspective. Now, if you've been studying real estate investing for a while, or you've already managed and purchased property, then getting started in small multi or larger multifamily might be the way to go for you. But in every case, it's great to start with a phone call to discuss your short-term and long-term goals. And then we can look at a strategy that fits your investing style and set out a game plan from there. Thanks so much for watching. If you like this video, give it a thumbs up, subscribe, and don't forget to share our videos with others that are interested in investment real estate.